All right, let's dive right into Bank of Montreal's Q3 earnings for 2025. And look, this wasn't just a good quarter, it was a decisive beat. And the whole story really boils down to one single number: $3.23. That's the one. That's the adjusted earnings per share. You know, when a bank reports, this is the headline number everyone looks for first. It's the instant report card. And for BMO, well, they absolutely aced. Okay, so let's put that number into perspective. The street, the analysts, they were all penciling in something around 296. BMO comes in and drops 323 on the table. That's not a small beat, folks. That's a blowout. And it wasn't a one-trick pony either. Revenue also came in strong, clearing almost $9 billion. So right out of the gate, you've got this incredibly strong story. So you gotta ask, how'd they do it? Was it just a lucky quarter? Nope. This was all by design. It's the result of a very specific strategy they've been working on, something management calls the return on equity rebuild. Now, ROE, return on equity, it sounds complex, but it's really just a measure of profitability. For every dollar shareholders like you put into the bank, how much profit does BMO spit out? Their whole game plan is about making that number bigger and better. And this plan, it's built on 4 key pillars. Think of it like a 4-cylinder engine. First, they're focused on squeezing more juice out of their U.S. banking operations. Second, and we'll talk more about this, is getting their loan loss provisions back to a more normal level. Third is just good old-fashioned operational excellence. You know, run a tight ship, control costs. And fourth, being really smart about how they use their money, their capital. They're pulling on all 4 of these levers at once. And is it working? You bet it is. The CFO, Typhoon Tunn, came right out and said it. Listen to this. They've executed on these initiatives, and it's resulted in a 130 basis point improvement so far this year. Now, for those not in the weeds, 130 basis points is a 1.3% jump in profitability. That's a big deal. It's real, tangible proof that this isn't just some PowerPoint strategy. It's actually hitting the bottom line. Okay, so this strategy is firing on all cylinders and spitting out profits. But now let's pop the hood and look at the engine room of the bank itself. We're talking about credit, capital, and what's coming down the pipe that could really move the needle. This is where you see just how healthy the bank really is. All right, before we go further, let's quickly define a key term you're going to hear a lot: PCL, which stands for Provision for Credit Losses. Think of it like a rainy day fund for the bank. It's money they have to sock away just in case some of their loans go bad. So it makes sense that when that number goes down, it's a fantastic sign. It means they're more confident in their borrowers and more money can flow directly to profits. And that's exactly what we're seeing. Just look at the numbers. Their PCLs dropped to just under $800 million this quarter. That is a big step down from where they were a year ago. And honestly, this drop was a huge reason why they beat earnings so decisively. It's a flashing green light that the bank is feeling much better about the overall health of its loan book. And you don't have to take my word for it. The bank's own Chief Risk Officer, P.O. Agrawal, basically shouted it from the rooftops on the earnings call. He said, and I'm paraphrasing, "We've passed the peak for losses in the U.S." For investors, hearing that about their most important growth market, that's music to their ears. It's a huge signal that maybe, just maybe, the worst is behind them. So, with all of this extra cash sloshing around, what's BMO doing with it? Well, they're doing a bit of everything, which is what you want to see. They're investing in growth, they're paying a nice dividend to shareholders, but the big one, the one that really got the market excited, is a massive new share buyback. They're planning to buy back up to 30 million of their own shares. And let me tell you, that is the ultimate sign of confidence. It's management saying, we think our stock is cheap and we're putting our money where our mouth is. So if you're watching BMO, what are the next big things to keep on your radar? There are really 3 key events coming up in the next few months. First, we're waiting for the final sign-off on that huge buyback in September. Then, by the end of the year, they're set to close their acquisition of Burgundy Asset Management. And finally, we're expecting an update on their Monoris payments business. There's a chance they could sell it, which could unlock a lot of value. So lots to watch. So we've established the numbers were fantastic, and the strategy seems to be working perfectly. But what really matters is, what did the market think? Well, the reaction was loud, clear, and very bullish. I mean, look at this. On the day they announced these results, the trading volume went through the roof, almost 3 times the normal amount. This wasn't just a quiet nod of approval from the market. This was investors scrambling to get a piece of the action. And this wasn't just a one-day sugar rush either. If you zoom out, BMO has been absolutely crushing it compared to its peers. Whether you look at the last month, the last 3 months, or the whole past year, it's been leading the pack. It's not just riding the wave, it's making the wave. Okay, so that's the story so far. We've looked at the numbers, we've looked at the strategy. Now let's do something a little different. Let's put on our analyst hat and talk about a potential trade, a way to think about what happens next, based on everything we've just learned. So, the big question is, what's the play here? With all this momentum, how do you trade it? We're calling this one the North American Growth Arbitrage. And the idea is pretty simple. The thesis is that BMO's U.S. business is a rocket ship, right? The credit picture there is improving fast. At the same time, the Canadian economy is kind of recovering a lot more slowly. So the play is to bet on that difference. You go long BMO, you buy it, to get exposure to that strong U.S. tailwind. And at the same time, you short a handful of smaller Canadian banks that are way more dependent on the sluggish Canadian economy. It's a bet that BMO will continue to outperform its more domestic-focused peers. And for that reason, we're giving it a rating of outperform. And one last thing before we go, and this is really important. Please remember, everything we've talked about here is for informational purposes only. This is not financial advice. You should always do your own homework and consult with a professional before making any investment decisions.